Hello everyone and welcome on Extreme TV. We have the pleasure here while visiting in Bahrain, the head office of Trusttree, of speaking with Mr. Michail KARAFOULIDIS, who is Corporate Services Officer within Trusttree. Welcome and thank you so much for agreeing to do this interview. So, Michail, what can you comment about the current investment landscape? Is it affecting Trusttree and in which way, in which manner?
Okay. Current investment landscape has been quite dynamically shaped in different formats since the crisis back in 2008. Trusttree operates in a specific part of the globe, what we tend to call MENA region. However, it still gets affected by global influences, by things happening in the global investment landscape. So Trusttree therefore has a two-dimension, or there's a two-dimension impact upon Trusttree: global developments and regional developments. Global developments have been characterized by low interest rates, low inflation rates, incredible volatility between United States dollar and the euro currency. A big thing for us as Trusttree has been expanding successfully in areas where the main currency is euro. And as we continue structuring profitable products and positions in those markets, our profits are worth less in dollar terms as we're being consolidated in US dollar. Just is the first level, the easiest implication to identify. Furthermore, we have the local landscape, which is mainly dominated by geopolitical issues and the oil price. Geopolitical issues have been catching the headlines the last few years, starting from Iran, going down to Yemen, tension sometimes between Saudi and Qatar, and all that would inevitably lead to sustained strength, I would say, of the US dollars, which can be harmful to us, especially in an environment where our non-US dollar assets are worth less.
How affected are you by the evolution of the dollar as a currency?
I think, first of all, volatility is an undesired element which is being introduced by the constant developments of the US dollar against a basket of non-pledged currencies in which we make business. And the reason I call it an undesired effect because is not giving us sustainable visibility over our income statement. Trusttree has been successfully expanding in non-US dollar pledged territories, and its ability to sustain an achievable budget within these areas when it comes to top line and bottom line is reduced, as the management has lower visibility of the implications. Now, Trusttree is not a trader in currencies, because equally one can argue that this is an ideal environment to trade in the currencies. It's a paradise for the traders, the volatility exhibited by the behavior of the US dollar. And not being a trader, but a traditional reinsurer, whereby we have a traditional asset allocation and approach to investment, is being negatively affected.
How exactly do you manage to balance your investment portfolio, taking into consideration that Trusttree operates on three pillars, as far as I understood, here in Bahrain, in Cyprus, and in Malaysia? So you are exposed to all sorts of currencies.
No, we operate in three pillars, but still the majority of our business, I would say 70% to up to 75%, depends on the composition of the portfolios within this year of account is in US dollar or in currencies pegged to the US dollar at a fixed rate of exchange. The fact that we've been expanding in non-US dollar pegged territories over the last few years, which means their importance growing within the portfolio, poses the difficulties. Now, the major currencies or the major exposure we carry is the euro exposure, and to a lesser extent sterling and Malaysian ringgit and the Indian rupee. Since last year, we entered the forward contract market, whereby, again, we don't use these instruments to make profits, we use these instruments to reduce the volatility of earnings being created by extreme movements in the rates of exchange of euro and US dollar. Now, using these instruments also has an opportunity cost, because if the rate of exchange goes the other way around, we have to fund the equivalent losses. But we take certainty within each year of account. In other words, we are sacrificing any potential profit which could have created if the dollar-euro rate of exchange moved in our favor. And this is the opportunity cost. And again, not being traders, we're prepared to incur it in order to stabilize the bottom line.
What is your relationship with the newer alternative risk transfer vehicles, which are being employed by cedents all over the world, more and more?
Yes. Alternative risk transfer, I think, is a subject hugely in fashion nowadays. It's an evil which has been created by excess liquidity in the financial system and floor low yields in government securities from US dollar to Europe. So it's inevitable that funds will look for yield. So when the 10-year US bond has been paying below 2% today, definitely the excess funds, liquidity, will take a chance in the Lloyd's markets or the insurance markets, where they can still achieve high single-digit returns or even double-digit returns in the mid-tens, as Lloyd's traditionally have delivered with substantial cash payments. Ourselves, we try these solutions as part of our capital management, but they don't work for us. These solutions is mainly aiming at the big seeding companies with insurance portfolio, mainly personal lines and to a lesser extent commercial lines. These solutions, they tend to be driven by the model, so it's like a kind of a roulette deal as the model output indicates, and people are prepared to deal in that and make a profit or loss within a very short period of time. Is not a solution, although we can see the industry has evolved now at a size which takes almost close to more than 35 to 40% of the total catastrophe aggregate in the globe as we know it today. So it starts constituting a serious industry and is there to stay. Although initially it was doomed as an opportunistic approach by funds with excess liquidity, say for instance a big player in the market was the UK pension funds, some of the European pension funds, because the current yields in the instruments available to them to invest, bearing in mind the restrictions imposed by the trustee of the funds in order to produce safe returns and assets to pay future liabilities of pensioners, they brought them towards the arena of the alternative risk transfer. And this has marked a departure from the traditional investment field they specialize historically.
Are you planning on expanding your activity onto this market also?
From our point of view, we didn't feel, first of all, we need a size which we don't warranty today to enter this arena. We've seen the traditional players, the behemoths of the industry, establishing specialized divisions back from maybe 10 years ago, but putting more emphasis nowadays because they need to increase their offerings to what fashion dictates in the industry. Fashion is very important, cannot be ignored. Some of the solutions, they thrive because of the upcoming Solvency II changes, which will alter completely the way insurers and reinsurers, they deemed their asset allocations in the balance sheets, and we'll talk about it later on if time permits. But at the end of the day, the fact of the matter is now we're talking about an industry establishing itself as a serious competitor to the traditional reinsurance industry. They are there for risk transfer. The question is, if we look at the solutions they provide, they tend to concentrate on the short end of the market, which makes sense because investors want visibility. What is their return and how quickly it can be distributed. So you will see them to take on mainly property and cat risk on their books. Therefore, there is a quick exit as opposed to a casualty portfolio, which may need 10 to 50 years to be run off pending on the jurisdiction.
Exactly.
Yeah. However, the real test, in my opinion, will come when yields start rising. It's been a persistent low yield environment, low interest, low growth environment over the last 6-7 years. Guidance we receive by organizations like IMF and there's central banks in Europe and America suggest that we should be paused or become fit to live in a low growth, low inflation environment. This automatically lowers the expectation of future interest rates because the markets they will move ahead to price things, not simply what we know today. In the price of an interest rate in a bond structure, we have the future expectations pending the duration of the bond, of the market mechanism with the ultimate size of the interest rates. So this, in my opinion, suggests that alternative risk transfer, insurance-linked securities, whatever names they employ today, cat bonds, they are here to stay. So it is imperative that the traditional reinsurers, they learn to live with the competition inferred by them and adjust themselves to compete.
But you are speaking about competition. The biggest added value that a traditional reinsurer can bring is basically security for its clients.
No, because to me, it's not necessarily as a bad evil in the system, in our industry, for a number of reasons. First of all, it changes the approach risk transfer takes place. It gives more choice to the ceding companies or more instruments to do their risk-based capital management. The fact that companies of trustee size cannot offer them yet, but we're developing a division which is heavily actuarially driven, and we have 2 products, and I will brief you about it, to come into foray soon, doesn't mean that people shouldn't look into them. But at this stage, the usage is limited to the short end of the market and for the direct insurance portfolio, as opposed to retrocession for a traditional insurance company as trustee is. Now, we saw an opportunity in the upcoming Solvency II environment to help small, medium-sized companies to meet the Solvency II standards at the regulatory prerequisites.
This was in fact, sorry for interrupting, but this was in fact my forthcoming question. How familiar are you as a company with the Solvency II requirements which will come into force January 1st, 2016?
Okay, I think it's a very good question. I think trustee is regulated in Bahrain officially, the main regulation, which is not Solvency II driven. However, since 2011, we have expanded our risk and actuarial department in a way. By the end of 2013, we're fully compliant with Solvency II. We have developed our internal economic capital model. We're filing already returns in our branch in Cyprus with the Cypriot Ministry, 100% of the standard of Solvency II. And we're going to have a first movers advantage in our territories when it comes around by leading the way. Trust 3 is already compliant 100% with Solvency II. And I think probably we're the only company in the area.
I guess this is extremely good news for your clients and partners, but why the need to build your own internal model?
It's a very good question, because it has two benefits. The first benefit is through this process, the management of Trust 3 acquires a more ERM embedded culture. Secondly, is a very good training and education for the management and the teams of Trust 3 about the changing dynamics of the marketplace, because that is what Solvency II partly is going to do, to be catching these changes in advance. And moreover, it makes Trust 3, which is unusual for a company of its size and the market it operates, fitter to be a play field player or an equal field player in the big arenas of our competitors. So it gives us credentials of an international standard, because this is what will be recognized as platform when we judge people's performance and financial soundness and security to be met.
Why would, I'm playing the devil's advocate for the moment, why would a continental European primary insurance company decide to work with Trust 3 and not with any of the other companies present on the market?
Yes, for a number of reasons actually. I think my immediate response would be the recognition of the brand. Let's not forget that it took at least a decade of serious work for Trust 3 brand to be built. And today, although it sounds like an oxymoron, comparing its size, wherever you go in the 4 or 5 continents around the world, whether Trust 3 makes directly business or not, the Trust 3 brand is known and recognized. For a company of 400 million equity, I think it's quite an achievement. That would be my first response. My second response will be the attitude of Trust 3 towards its business partners. And what is special about it is the personal touch it gives. To give you an example, today, to place even the biggest risk in the world, all we need to go is to London, where you have 7-8 billion capacity concentrated in one bit, to Zurich, to Bermuda, it is gone. Actually, the placement is completed in less than 1 hour, I would say, very easily. So these people, they don't need to try as hard as Trust 3 did or has been doing over the years to get the clients to know it. So we have our people on a plane close to our clients. Trust 3 is very close to our clients. The size of Trust 3 increases flexibility to make tailor-made solutions, because this contradicts the traditional say, but you need a bigger balance sheet to do that. Yes, but a much bigger balance sheet may not be able to act as timely as Trust 3 would do. Trust 3 within 24 hours, maximum 48 hours, will respond to the client, and Trust 3 is the first to pay its claims. I think all these actions or features in the behavior of Trust 3 over the last 10 years at least have been contributed or cementing the soundness of the brand of Trust 3.
Where do you see the company in 25 years from an actuarial point of view?
I think Trust 3 has another unique characteristic. It is a corporation, but still a family-owned run business. It combines two dynamics which sometimes they cancel each other when it comes to coexistence, corporation and family business, which is very common here in the areas we operate. Most of the big businesses, they tend to be family or partly family-owned by families with serious wealth. So Trust 3 belongs to a portfolio of businesses called Nest Investment Holdings, which is a financial conglomerate specializing in the same parts of the world as Trust 3. I think compared to other assets in that portfolio, Trust Three's significance is reducing because there are some mega projects belonging to our parent, which we're talking multi-billion assets here. Again, Trust Three with 400 million equity, close to 400 million, starts to become smaller and smaller. However, it's so important within this structure when it comes to efficient risk transfer within a multi-billion financial conglomerate and offering vertical solutions to its clients. It has added value, embedded value, which is not recognized in the visible equity. What is the current trend? I mean, we can go as far as maybe the next few years, the visibility we have. Now, suddenly we are in an environment bigger is better. We see mega mergers taking place in the industry. However, equally, we see new entrants coming very easily because the barriers to entry in our industry are very low, in my opinion. All we need is access to a pool of capital and a big checkbook. We set up in London, in Bermuda, in Zurich within 6 months up and running. No need to invest in know-how or infrastructure and creating, producing assets over a number of years before we enter the market. We can do it within 6 months. We can attract the best actuaries, underwriters, accountants, chief executives in those 3 centers just I mentioned. Set aside how many others there are in Europe and America. Therefore, Trust Three, bearing in mind its size and its organic growth, it would seem like we'll be staying behind these mega structures created. I still believe there will be room in this marketplace, in this world, for smaller people, but smaller when it comes to a figure approach from its balance sheet, but part of something super mega, which could be equivalent to these new mega structures created in the industry. So Trust Three maybe is a fallacy to say is a small reinsurer. It would be more correct to say is a small reinsurer by international standards today with a very powerful parent behind it. This answers your question, or to summarize what I'm trying to say, I can see Trust Three being there either as a standalone entity or as a bigger entity possibly. I don't think our ownership has ruled out the possibilities of partnering with other people if they fit our culture and our business model, but still Trust Three brand is a very important asset to Nest Investment Holdings and will be there growing and thriving in either format.
Thank you for that. But yes, obviously. But as a final question, we mentioned the idea of ratings. You were recently upgraded by SMPS. How does that impact your activity, and how were the clients' feedbacks on that?
Definitely very positively received, and especially we're the first in the region, and were make us feel very proud of Trust Three and its people and who we are. Our clients have welcomed it, although Trust Three would still make business with clients in environments where an SMPA minus was required without having it because of who Trust Three is. And as I said to you, the value of our brand is very significant.
Because of the brand, obviously.
So, what is the extra brought to us now? It made it easier for our clients to increase our participations. It made us see new business, which we wouldn't see before because the brokers wouldn't show them to us due to the fact they knew we wouldn't have the rating to deal with it. It made us more competitive now to structure front-end solutions for the clients, having the minimum rating requirement, as opposed to having to find a partner to be the front-end part of the solutions, and Trust Three to structure, do all the work and be at the backside. And furthermore, in the current environment, which is characterized by overcapacity, all the high desired risks, they tend to be 2 to 3 times overplaced. It helps us being more resilient or be more defensive to protect our lines or to suffer less signing down in our lines. Therefore, it has enhanced the defensive credentials of the operation.
Well put. Extremely well put. But again, and this would really be our final question, what is your capacity at the moment, your insurance capacity?
We have various capacities. First of all, Trust 3, it's important to say that, it started its existence as a small boutique reinsurer for energy projects. So it made its name in the energy industry due to the connections of Ghazi Abu Nahl, of our owner. And by the way, I would like to say here, Ghazi Abu Nahl was the first one to pay the Piper Alpha losses in Lloyd's in late 80s. So we have a strong link in the energy sector. At the back of this success and the growing importance of their insurance operation with Mr. Ghazi's, which Mr. Ghazi is the ultimate owner of Nest Investment Holdings, portfolio of businesses, we started growing successfully the treaty business in early 2001, 2002, especially in the aftermath of World Trade Center disaster, where Mr. Abu Nahl saw a unique opportunity to build a risk carrier in the area. He saw that there was room as the area was growing in the prosperity and the importance of the energy industry. As a result now, Trust 3 has started to respond to increase its offerings, its product lines, bearing in mind the needs of the clients. The more we understand the clients, so therefore you see an amazing evolution from an energy writer to be a multi-line writer, specializing mainly in the short end of the market. We don't offer casualty solutions, limited offering, and even this year we entered the life arena. But how we did that? By bringing the right human capital. This is very important, doing our homework and understanding the business. So we go step by step, we walk before we run. This is a famous say by Mr. Fadi Abu Nahl, who is the CEO of this operation. So from 5 to 10 million capacities, today we have up to 80 million capacities, which due to some developments which are cannot talk to confidentiality reasons at the moment, this could increase well to the 100 million range. So we don't fall short from the big boys in the area. And again, it is very important to understand here, we're not competing in the mature markets. We're not interested in the mature markets. This is not our bread and butter. We're competing in the emerging markets. This is where we specialize, and the business model works.
And this is probably an excellent message to conclude this interview. So thank you so much.
Thank you very much for offering me the opportunity to talk about Trust 3. I really look forward to more successful updates in the future.
Thank you so much.